Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 337 of the Independent Advisors Podcast. On today's show, we'll be covering a few timely and important topics, including net flows into consumer staple stocks, housing affordability, relative performance of hardware versus software, update on the January barometer, economic cycle discussion, and important dates that will occur for the market in the month of February. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. This week, my guest host, Aaron Kramer. Welcome, Aaron.
Happy to be here.
I don't want to forget, Aaron Kramer, CFP.
Appreciate that.
Absolutely. You worked hard for that. It needs to be said.
Love it. I appreciate that.
So before we kind of dig in to big headlines and current events, Mr. Kramer, you want to do pricing for our listeners and viewers?
I am ready. Let's do it. Starting off with the S&P 500, year to date is up 0.4%. Excuse me, if I can speak. Month to date is down 0.81% or 81 bips. The Dow is up almost 3%, 2.99% year to date, up 1.25% month to date. The CompQ or NASDAQ is down 1.45% year to date and down 2.38% month to date. IWM, which is small caps, is up 5.83% year to date and up 0.34% month to date. VEU or Vanguard or the ex-United States FTSE All World, that mouthful of an index, is up plus 6.44% for the year and up 0.73% month to date. The 3-month Treasury sits at 3.67%, 2-year Treasury sits at 3.50%, and the 10-year is at 4.24%.
And all that data comes from stock charts at 9 a.m. this morning. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Perfect.
One observation I want to throw out there, Mr. Kramer, has to do with international performance.
Very strong again.
Strong again to start the year. Observation we've talked about a couple times in the podcast, dollar weakness.
Mm-hmm.
So,
kind of juices up that international return, doesn't it?
Bingo. And so I wonder if people front load this trade a little bit more and the dollar starts to strengthen, that obviously is going to become a headwind for international stocks, at least through the lens of history. When you look at Trump's first term in presidency, the dollar weakness bottomed in the first half of his second year. And that's exactly where we're at.
Yeah.
So if history repeats itself, I'm not saying that it will. I think there's a lot of market participants looking strongly at the dollar.
Let's say the rotation.
first half of this year. And if you start to see some dollar strength, it makes me question how these international stocks will hold up. Exactly. Well, let's go to big head. I think it's going to be interesting to see how this all pans out on that front. Big headlines and current events, Aaron. Just the big thing I think it's been talked about in the market this week is additional headlines regarding AI developments, and that's been fueling market volatility. So how I'll kind of categorize this for our listeners and viewers, this is not the first time. This is kind of a rinse and repeat kind of topic over the past couple of years. So what's happening this past week? There has been a little bit of a sell-off in software, some data analytics and AI-related stocks. It's partly triggered by new announcements of AI softwares that are available. It's contributing to market volatility as investors are trying to pan out potential winners and losers. my initial reaction when I see this type of action. This is very speculative.
Short-term
This
volatility.
Exactly. People are shooting first, asking questions later. Historically, these things tend to provide, I think, opportunities.
Yeah, absolutely.
But, I would expect this type of volatility as the year goes on, not only on the political front. And I know I spent time going through a listing of double-digit topics and themes to watch, but I think as the year goes on, continued announcements of innovation on the software AI tech side, you got to expect it.
Yeah, absolutely.
You have to expect it.
It's a fluid environment right now, for sure.
It really is. So, Aaron, why don't you start off? What caught your eye this past week from kind of a research or topic standpoint, sir?
Yeah, I was perusing Twitter, or X nowadays, and found some good pieces here. The first one is a post from Joe Weisenthal on February 4th, so yesterday. It's
hot off the press, baby.
Yeah, it's hot off the press.
Hot off the press.
A chart from Bank of America, their research group, and it shows net flows into consumer staple stocks. So his tweet says, Bank of America says that buyers have been pouring into consumer staple stocks at the fastest pace on record. So this is going back to 2008 is where this data is from. So that's interesting to me. I think it's, it might kind of play into what we've been previewing and thinking.
Yeah.
We might see some short-term rotation into these areas.
Yep.
As tech prices are slightly elevated right now.
Yep.
But I don't know. I think it might be short-lived. Is my opinion. What's your opinion on it? Not to give recommendations for or against these areas of the market, but
I think you articulated that very well, Mr. Kramer. What goes through my head is consumer staples were so beaten down last year. I believe this is a pretty good statistic to throw out there. A lot of the brand name consumer staple stocks, a lot of them were off like over 30% last year.
the Procter & Gamble's, the
Clorox is the General Mills, Colgate Palmolive's, Kimberly-Clark's, Church & Dwight's. Not all of them were off 30% last year, but a lot of them were.
Sure.
And what happened is the dividend yields that these stocks were spitting off, some of them became north of 4% a year. And I think that became very attractive and juicy in this environment.
Might be even more attractive as rates come down, though, right?
You got it, right? I wonder, like you, if this is a short-term sector rotation. If Mark were here, he would make the comment that sector rotation is the lifeblood of a bull market.
Yeah, absolutely.
So as we see these pauses, let's go back to your comment about tech, because I do think it is spot on. Let's say tech takes a rest for a quarter, 3 months, and you see more conservative, unloved, beaten down sectors of the market catch that bid. I think what happens for investors, though, is you reach this paradigm where we're going to get earnings again in another 3 months. And all of a sudden, the realization and the facts hit you right in the face.
What is General Mills growing their top line and bottom line at?
Bingo.
Versus
XYZ.
XYZ stock, right?
Right? And I think that is the issue for longer term investors in these slower growth names. Again, not for or against any other name we just mentioned, but interesting that you picked this.
I thought it was kind of a very interesting data point, and I thought it was kind of a good sign.
I like it.
Kind of with Mark's theory that rotation is important. Right?
Yes, it is.
All right. Got another good one for you. Just wanted to check in on housing affordability.
Ooh, that's a hot topic these days.
Very much so. It is an X post by Rick Ryder on February 3rd, and he has two charts here. He kind of posted them back to back in the same post.
Okay.
So I'm going to read his first one. CIO charts of the week. Housing affordability continues to be very strained, particularly for young and lower income cohorts who are disproportionately being shut out of the housing market as first-time home buyers. Today, median age of first-time home buyers is 40 years old, up from 33 years old in 2019. That's a very interesting stat to me right now. It just goes to show that it takes tons and tons of time to be able to save up and have the ability to afford a house right now.
Yes.
So it shows the chart here, median age of home buyers. So all buyers, average age right now is 59. First-time buyers obviously is 40, and repeat buyers is 62. So
Well, we see that trend in our client base, right?
absolutely.
We see-
Downsizing,
you got it.
moving across the country, warmer climates, all that good stuff.
Absolutely.
Right? So
No tax states.
absolutely.
That's a hottie. That's
Yes,
a hot
it
one right
is.
there.
Yes, it is.
Yep.
His second chart here, this is an interesting take as well. So he says, if we assume the average person has a 45-year-long career, they would now be spending 21 years or 47% of their working years waiting to buy that first home.
Isn't that a stat?
That is a worrisome stat for me. We continue to believe that lower mortgage rates are key to easing some of the affordability pressures and to supporting, and it's cut off there, but that's the general point.
You know, it was interesting. Trump was speaking at the World Economic Forum, must have been a week ago, maybe 2 weeks ago. And he was talking about housing affordability. And he said something that kind of piqued my interest. He said, bringing down affordability prices is a double-edged sword.
Right.
Because you have all of these individuals that are sitting on all these huge equity gains in their home, especially the last 6 years.
Absolutely.
And if you bring down affordability, you're going to make homes more accessible.
But how many people are going to be upside down?
There you go, right? And he was kind of talking about that double-edged sword and how they're going to try to, get innovative, because I do feel as we get closer to the midterms and the next presidential election, these are the topics that I think will start to rise to the surface.
Absolutely. Well, I think that Rick here makes a good point, is that rates might be the less of the double-edged sword, right? Because if prices stay the same, but rates come down,
makes it
people
more
have all their equity still.
and
it makes it more affordable, right?
Yeah, I'll be curious to see how sticky the long end of the curve remains as shorter term rates come down, because I do feel that there is some feeling in the marketplace that the spending habits of the American government, apolitical to which side of the aisle has the power at that time, they're going to continue to borrow money we don't have.
Right.
So I think that is going to be the issue for the market to digest, which could make stickier or higher long-term rates.
Yeah, absolutely. I'm in full agreement. I think
You know what I mean?
I don't see the ultra-low COVID rates ever again, or not for a very long time, unfortunately, for buyers and younger people.
Yeah. We'll
But,
see if the administration's able to stay in, taking personal politics out of it. Their goal is to try to grow out of the deficit borrowing. We'll see if that is possible, right?
Who knows? We shall see.
We've seen crazier things.
I got one more for you here. This is an ex-post from Bespoke Investment Group, and it is a check-in on relative performance of hardware versus software, and this is from February 3rd. Perfect kind of segue from the AI kind of news headlines, right?
Well said.
So Bespoke says, amazing dichotomy between tech, hardware, and software stocks over the last year. Hardware and semi stocks are up the most of any group with average gain of 50+%. Software stocks are down the most of any group with an average decline of 20+% down. So, I mean, what's your take on this? And I'll give you mine.
I believe there's more disruption right now with potential in the software space than there is in the hardware space. I feel there's a lot of production bottlenecks in the hardware space, giving those companies more pricing power, higher margins.
Sure.
And just general themes. On the software side, it kind of goes back to market events you were seeing this past week, where people are reacting very quickly and extreme and making some assumptions that might not be true with some of these headlines.
Basically kind of thinking that this hardware and the AI side is going to take away all the value in software, right? Which I don't think is accurate.
Or commoditize it to a large extent.
Yeah.
Right? Interesting.
Yeah, I don't think
Curious to see how that goes.
semis and AI are complete replacement for software or for coders and developers. Not yet, but I think it provides. It's going to make it cheaper.
Yeah.
Right.
Yeah.
So interesting. Yeah. That's a big dichotomy for sure. So
it is. I'm glad you pointed that out.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
The first thing that I got is a topic about the January barometer. I'm going to make this a little brief because we did a piece, Aaron, me, Mark, and Jenna, for our Questions with Matt and Mark that we do weekly on our social media. So this was a piece that we picked. It's interesting because I had this on the sheet.
It's a great data point.
And then Mark grabbed it for the Questions with Matt and Mark piece independently of me knowing. So
Great
for
minds,
those,
right?
right? So for those that did not see this, there is a old Wall Street adage about so goes January, so goes the rest of the year. And the term that they've coined it is the January barometer. Here's the quick stats. When you have this data point, Aaron, goes back to 1950.
It's
and
a lot of data.
The underlying source here is Ryan Dietrich at Carson. So if the month of January is negative for the S&P 500 going back to 1950, when it's negative, for the rest of the year, the final 11 months, the average return is only 2.1%, with a positive rate of a return of 60%. However, if you have a positive January, it is just up. You go from an average return for the remaining 11 months from 2.1% if it's negative, Aaron, to 12.2 being the average return, with a positivity rate of 87%. Just like Mark said on Questions with Matt and Mark, does this guarantee, one, a positive year, or two, does it guarantee a double-digit year for the S&P?
Absolutely not.
It does not. However, looking through the lens of history, this tends to be a positive barometer to look at.
Yeah.
And it turned out positive. The final return for the S&P, 1.37%. The NASDAQ was up 0.95. Sources on that data was stock charts on January 31st, just a little bit ago. And one thing I thought was neat is when the S&P's up over 2% in January.
It's even stronger.
It's just slightly stronger, but the positive rate drops to 84.8%.
Weird.
Interesting, isn't that? All right. My next piece is going to be a little bit longer, and I have one after that that's just going to be some dates that I think investors will want to pay attention to here in February. This first piece is something I noticed, a blog post, Aaron, by Ben Carlson. And he had a blog post titled, Why This Economic Cycle is Different. And it caught my eye.
Yeah, I read it too.
Did you read it?
I read all of this stuff, so
Okay.
I love it.
So you're probably already aware. So I'm going to read through this and just feel free to interject.
Yeah,
I'll do the
absolutely.
same. I thought this would be a good piece to share with our listeners and viewers.
Perfect.
So again, he wrote this on January 27th. Here we go. I recently wrote a short history of credit cards in America. Here's the short summary of consumer spending in the modern era. Consumer credit took off for the first time in the Roaring '20s as Americans desired all the new household innovations that came to the market. The Great Depression crushed the stock market, crushed the economy, crushed the consumer, and turned a generation of households into penny pinchers who were too nervous to spend money. After World War II, that all changed as consumer credit exploded from the build-out of suburban America in the middle class. Credit card burst onto the scene in the 60s, which took spending up another level. Then the 1970s inflation hit, and debt was actually an asset in some ways because purchasing power was being eroded so quickly. By 1980s and 90s, consumerism and debt had taken over the average household's mindset and bank account. We love to spend money in this country, and we're damn good at it too. Am I allowed to say that, Jenna?
It's too late.
In many ways, the great financial crisis was caused by the debt accumulation over the previous 30 years or so. That cataclysmic financial crisis was years in the making. But after the 2008 crisis, households on aggregate learned their lesson. No more cash out refinancing to take vacations or buy more houses. No crazy ninja loans. No more adjustable rate mortgages. Household repaired their balance sheets. Yes, debt has continued to rise, but that's going to happen when the economy grows. The good news is that debt has risen at a much slower rate. Take a look at the change in household assets and liabilities by decade going back to 1989. Now, Jenna will put up this illustration for our YouTube viewers. This will be in our show notes. This is going to be a graphical representation that Ben attached. The underlying source is Ritholtz Wealth Management. Shows household assets have grown faster than liabilities. Data set goes back to 89. Any comments before I continue reading this, Aaron?
No, I'll let you give the numbers there first, then I'll interject.
All right. From 1989 to 1999, the household assets and debt grew at a similar pace, both doubling in size. Then, from 1999 to 2009, the debt grew much faster than the assets. 2 recessions, a housing bubble, and 2 stock market crashes had a lot to do with this, but was obviously not ideal. Now, look what happened from 2009 to 2019. Assets grew way faster and the growth in liabilities slowed dramatically. Same thing happened this decade as well. The growth in assets is outpacing growth in debt. This is why household net worth is at an all-time high. Matthew Klein at The Overshot tries to put the wealth gains this decade into context, Aaron. In other words, $66 trillion in net worth was added in less than 6 years, equivalent to more than 3 times of all the personal consumption expenditures in 2025. Obviously, a booming housing and stock market have a lot to do with these gains.
Yep.
The housing market's a perfect encapsulation of the differences between asset and liability growth this cycle and why this time is different. In 2009, the total value of the housing market in America was roughly $19 trillion. Total mortgage debt outstanding was a little bit more than $10 trillion. Today, the housing market is worth roughly $48 trillion, while mortgage debt outstanding is $13.6 trillion. Isn't that...
That's my favorite stat of all of this.
I mean, that is just crazy.
People were calling for a housing bubble the last 5 years, essentially, right? I'm not going to say
not many
there's
people
no
are,
way.
Not many people are underwater right now.
They're
There
not
are
looking
people.
at that stat, right? There are, but there's not many. Right?
I'll say it again. Today's housing market's worth $48 trillion with mortgage debt outstanding of $13.6.
That's like 25%.
That is just immense. I'll continue. Mortgage debt makes up around 70% of total consumer debt. To be fair, this was once in a lifetime housing price boom. Mortgage rates were at generational low levels. This won't last forever, but this is one of the reasons why households are in a much better position from a balance sheet perspective than they were in previous cycles. There's a case to be made that household balance sheets have never been in a better position than they are today. If you look at the counter argument is that household balance sheets are in such a good place because government debt is so out of control. Here's a look at household and government debt to GDP going back to 1970. And what it does is it shows household debt as a percentage of GDP and government debt as a percentage of GDP. And again, households are looking quite good compared to the drunken spending of the government. So I'll continue. I'm almost done. As households repair their balance sheets coming out of the 2008 financial crisis, the U.S. government borrowed more money than ever. Government debt to GDP has skyrocketed while household debt to GDP has fallen considerably. The government debt level is a topic for another time, but I would much rather have the institution that has the ability to print more of the global currency and tax its citizens taking on debt rather than households. Household balance sheets won't always look this clean. At some point in the cycle, they'll turn. The economy will go into a recession. Asset prices will fall, liabilities will rise as consumers borrow money to stay afloat. But the good news is that households have never been better positioned to weather the storm. The capacity to borrow is now much higher because the growth in debt has slowed. This is not like previous cycles. This time is really different. And he mentions some further reading on the topic.
Yeah.
I'll let you go first for any additional comments.
No, I think he perfectly frames this. I think it's a great evidence for how resilient the U.S. consumer can be if there is a recession in the future.
Yep.
And I think, I think people are positioned to take on more challenges. Yeah.
And again, we're talking about the average household.
The average, yeah. There's going to be some that are definitely underwater and not as pretty as this. There are going to be some that are way better than us, right? So that's
correct. I think about a stat I talked about on the podcast over the past 2 months, and it was a percentage of the average American's household, what the average household's net worth was in cash.
interesting.
And the stat showed a chart going back to 1950.
Okay.
And the percentage of assets has risen the past 6 years to 7% of an average household's total financial assets being in cash. That is the highest level since the early 50s, coming out of World War II.
Wow. Interesting.
So I just want to throw it out there that when I look at the hard data, if someone sits there and says to me that the consumer is overextended, my immediate reply will be, yes, there are definitely subsectors of the American consumer that are, but on average, that is not factual.
It's great.
It's not.
It's a good data point.
All right.
Love it. Love it.
So last thing I want to do is preview some important dates for the market here in February. I'm going to start doing this a little bit more.
Yeah, I like this.
Because I think what happens is you have these more volatile days, maybe with some releases, and people might wonder
what's going on, right?
Okay. So a couple to throw out there that caught my eye for the month of February. First is we get the inflation print for January to be released on February 11th. To give people some insight, the previous year-over-year number for CPI was 2.7%. The real-time data, there are research companies that try to predict or reflect real-time prices. They're showing year-over-year inflation and real-time data coming down very quickly. So I'm curious to see how quick these numbers catch up. I will help interpret for the market here, and I'm going to go out and speculate here. My speculation is this number, CPI, continues to come down, puts more of a pressure and expectation for the Fed to lower interest rates.
Yep,
all right.
Agreed.
Next, we get U.S. retail sales. It's going to be released on February 18th. Investors are going to be looking to another data point on the health of the American consumer. Then we get U.S. GDP. The advanced estimate for the fourth quarter of last year is going to be released on February 20th. There will be some effects of the government shutdown in that release number, but I'll tell you, I think it's going to be juicy. Next, we get U.S. Producer Price Index. That's going to be released on February 27th. That's going to give us some read-through, Aaron, on what manufacturers are seeing on the inflationary front.
More
CPIs,
like wholesale price type things.
Bingo. And last but not least, with all the talk about tech and AI over the past week, this could be a rinse and repeat of November all over again, where the market waited until NVIDIA, not a recommendation for or against, it is one of the largest market cap stocks in the world. They're releasing their earnings on February 25th. And I'm just highlighting it because it's going to create a lot of volatility leading up to it and after that announcement.
Most definitely.
Is that a good way of saying it, sir?
Yep. Perfect. Good stuff.
All right. It was a good podcast. Let's skip the financial planning topic of the week. Anything else, Mr. Kramer, top of mind, sir?
No. I just think, we've kind of said this already. Some short-term volatility, I think, is in the future, through early this year. I think a lot of it will be short-lived, just bouts of volatility, but that's normal. Right?
Yeah. And I'll just kind reminder, when we look at the average midterm election year, the average intra-year drawdown at some point, it's high, Aaron. It's like
10%.
It's like 17.
Wow.
But the average intra-year rally during a midterm election year, and this data goes back to 1950, is over 30%.
Wow. So it's a volatile year is the theme.
You gotta expect it. This is definitely a year I would be focused on the long term because I think that we've had a crazy amount of headlines in the first 5 weeks of this year. Expect that to continue. Yeah. Your bingo card is going to look pretty messed up by the time you get to July.
It's a check your account statements once a month, not once a day.
There you go.
Year, right?
I like that. I like that. Well, let's sign off. Thank you, everyone, for listening to episode 337 of the Independent Advisors Podcast. That just rolls off the tongue. Aaron, myself, Jenna, Mark, Taylor, the whole team, Nick, we appreciate you listening, and we'll be back next week with episode 338.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.